Hey guys and girls, it's Nathan Birch here from B.Invested.com.au, and today I'm here to talk about the difference between buying one bigger ticket item or multiple smaller items. And I'm going to just start by drawing a little divider in here and look at a couple of different scenarios. Let's say we've got 500 grand in capital and servicing, so maybe like a deposit and a loan, and the ability to buy $1 million worth of stuff over here. Let's assume that we're spending 500k in, suburbia of Sydney or Brisbane or Melbourne or Perth or wherever the case may be. Let's say you buy a 500 grand house or unit or whatever, and it returns $500 per week. I like buying properties that are in metro areas. The reason being is that you have good consistent growth over time. You've got strong rent returns, an abundance of tenants, an abundance of purchasers, and a lot of infrastructure goes in, so there's more opportunity for growth to happen. Looking at this, let's say for instance we buy option A. That would be a 5% yield or 5.2% yield to be exact. Looking at the growth potential of that could go up, and we can forecast in the future. Let's look at the other option here of 250k property times 2, and let's say for instance it rents for $300 per week times 2 equals $600 per week, and you got about a 6% yield or something, not a 60% yield. I don't know how to do percentage signs sometimes, guys. Let's say we go over here and we look at a $1 million property and a rent of say $1,000 a week, I'm being conservative here, and then say we buy 4 times $250,000 properties with $300 a week times 4 is $1,200 per week times by 52. As we went on to our yield video, we're sitting here with about a 6% yield. Did it again. 6% yield, guys. So as we can see, there's different scenarios, different options that we can go. If we go for the 500 grand for one house or unit or whatever it is, you've got a lower yield, you've got it all risked in one property, and it's not spread out. So your risk is that you've got your exit strategies a little bit tougher if you get yourself into difficulty or whatever the case may be. If you need to sell it, you need to sell your whole portfolio. If you purchase it this way, you can sell one and keep one. There's opportunity there. The reality of it is that in each area, if we look at, I'm just going to draw in the middle here and draw Sydney, and then look at the rings around Sydney. We've got like outer rings, we've got inner rings, we've got areas which have different profiles of income earners, etc., etc. Go check your census and see what the numbers are for exactly. But there's different areas, and in each of these areas there's a wage capping. There's a point where it comes where you can, like at $1 million, not everyone can go buy $1 million property. Some people are fortunate enough to, some people fortunate enough to that, some people are fortunate enough for just one of these, and some people can't even buy into property. So what you got to look at is, can this property go up and continuously go up without the demographic changing in these areas? So from my experience, from looking at properties when I first started investing, looking at properties that were in these sort of category of areas, these ones went to, say 750k. These ones might go to, 400k. This one here might go to 1.5 mil, 1.6 mil, whatever, 1.5 mil, and these ones here to 400k again. These are just all hypothetical numbers and just used for educational purposes. The reality of it is that these rents, this one here might go up by $100. These ones here might go up by $80. This one here might go up by $150, and these ones here might go up by $80 as well. The outcome is different because you can hold on to this property when the rent goes up by $100. Might be neutral then, and it might stall you from buying other properties. At this point, this was neutral to start off with or whatever. $80 a week times it by 2 equals 160 a week extra per week extra. So the new rent is $760 per week, where this one here is $600 per week. So as you can see, as the gap, have you ever seen those car ads where probably about 10 years ago, the car ad shows that if you steer off in a direction, the line of direction when you're driving down the road, let's say for instance this is a road here, if you swerve off the road and there's a tree here, you swerve off. If you're driving at a slower speed, it'll just hit here. But if you project it, it'll end up there, and that line of travel it'll go. If you put these two properties side by side and look at the next decade and see where they will go, they will take a different turn, because as you move forward and move forward and move forward, these rents will just continue to grow exponentially, where this one will just grow in one line. This one here, you've got less risk with it, higher upside for growth, because there's more people can afford 250 grand than what they can to 500,000. So the people that are in this ring will go out and buy more properties, these areas will clean up, and then this area will clean up. There's a lot more growth that I've seen over the past decade in these bread and butter blue collar areas and what I have to these, mum and dad red brick areas. In these areas here, out in the more expensive suburbs, volatilities like that, because what happens if the GFC comes again and people start losing their jobs and losing their Porsches, God forbid, people lose their Porsche and have to go bank repo on it, they can't afford their house at top end of town, and that can come back. Like, let's say for instance this property here could lose 200 grand overnight, and you'd be like, shit, where's my 200 grand gone? My property is only worth 800k. Tell me if you haven't seen a property that's lost 200 grand at that sort of level in a downturn. You look at these properties here, is that property going to lose 200 grand? Are you telling me that properties are going to sell for 50k in Sydney or Brisbane or Melbourne or Perth or wherever? It's not going to. So the risk is a lot safer here. There's a lot more upside for growth than these two fellas. If you compound your effect, this is by saying you've got four of them, you're going to get an extra 300, that was 160, so that'd be $320 per week in rental difference, just from putting the rent up on each of those four properties. Yet this one here will only go up by $100. So there's no right or wrong. At the end of the day, whoever gets to the beach quicker is, got there quicker. But people say this is the best way to go. People say this is the best way to go. I think this is the best way to go, because as long as you're buying good quality assets with the upside for growth, below market value and a strong rental return in this end of the pool, pina coladas will be there one day. It's something that's helped me from working 2 full-time jobs to being able to be financially independent, do things on my turf, how I want, when I want, have the choice of going away, going to the beach, going to the office, making YouTube videos, making connection with you guys watching this, and it's something that's been good for me. Sometimes people want to ask these sorts of questions, so I encourage questions to be asked. So if you've got any further questions, put some comments below, subscribe to YouTube, add some questions on Facebook. If you've got any questions that you want to meet into the office or anything like that, you can contact the office on the number below. We'll talk soon. Have a great day.